So let's go through what we're seeing in the markets right now. I think resilience is the right word to use, right? Okay, we've seen the decline, but investors seem to be happy to put this higher for longer Fed narrative to one side.
Yeah, I mean, obviously we've had virtually 10% declines. So there's even dead goldfish bounce. And I would say that people are enjoying this. You are right. People seem to want to come to terms with the magic numbers 4% GDP growth, 4% unemployment, roughly, 4% inflation, roughly, for the moment. And so, yes, I think the investors, stateside specifically, are content. They're struggling a little bit, having kept the US economy afloat for a long, long time. But yeah, investors are coming back into the market. They've seen these declines and they're looking at profits to be made.
Indeed. And the Fed just kept rates on hold at a 22-year high this week. I'm curious to get a sense from you about where you see Powell going next. Is this higher for longer narrative basically locked in? Is this the pause that markets have been looking for?
Well, Powell is in a very, very difficult position. Obviously, having very strong inflation. At the same time, I've been coming on for a while now. I'm saying there's not even a soft landing. We've got growth. So we had the dual-headed monster of growth but horrible inflation. And so they're on a tightrope. I think that the pause is a really smart thing to do. I see inflation rising into the new year. And so it gives the consumer a pause to enjoy a little bit of respite from what has been significantly rising interest rate burden on free cash flow for them, and at the same time gives him let's just watch the data a little bit more. As you say, the jobs numbers are super resilient. The economy is super resilient.
What's also been interesting is this Treasury financing announcement that came out this week. I think the tighter financial conditions clearly maybe doing some of the Fed's work for it here, but what's your read on where yields go next, and how important was the announcement that we saw this week?
Well, it was not a huge, massive difference in issuance. So it came down from 114 billion in August to about 112 billion now. But it's a signal it sent, and it was the 30-year and the 10-year that were not being issued so much. And those are the rates that really impact the consumer. So it was the Fed. It was basically an indication that, we are looking after you. We we feel the pain that you're suffering, and we're going to be a little more careful. And so, yeah, I think it's a great indication. I think the Fed want to pull the longer dated down as low as possible, and that will free up the consumer again. This month we saw sentiment fall below 50. So there is softness. But then again, if we look at heavy truck sales, my favorite metric, after last year's COVID insane blowout recovery, it's still up 6%. And we've never had a US recession when heavy truck sales are through the roof.
Where could we see financial stress, though, as a result of this 22-year high in rates? I know this is something you're looking at closely.
Yeah, no, it's really interesting. We saw a 1% increase in spending last month, and yet at the same time, we only saw 0.3% increase in income, which means we saw dissaving. Dissaving now is around 2008 levels. And one of the things that we're also seeing is that obviously the interest rate burden is causing net free cash flow of US consumers to be going the wrong way. So the US consumer is suffering financial stress. And that is set to continue for a while, and that's why I think the Fed was super clever to pause. And the issuance is also affecting their interest rates.